Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, this week marked the return of meme mania. Did you see that chart of Bed Bath & Beyond? Holy cow! Today, interest rates on the 10-year went up. The dollar went up. Is the Federal Reserve finally doing what they said they were going to do? And Bitcoin broke out of that really tight ascending triangle. Let's take a look at the charts. At the time of this recording, it is late on Friday evening, so the futures market is closed. Hey, before we get to the charts, if you like these videos, please don't forget to hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of these videos is posted. Thank you. We really appreciate it. All right, looking in today's chart, you can see that there's something for everybody in this chart of the SPY. In other words, if you're bullish or bearish on the market. So you can see we did move to the downside today, but we closed right on top of the 10-day moving average. So one could argue that all we did was just correct a slightly overbought condition from the 10-day moving average. But we have to respect that wave 4 hitting that 61.8% Fib corrective level. It's my favorite level. I think it's the strongest of all the Fibonacci levels. And when you have that in a corrective move within a 5-wave impulse pattern, it warrants watching. I know that's a pretty big wave 5 to the downside, but if the Federal Reserve does start withdrawing liquidity, I think that could happen. We'll take a look at the chart of the Fed's balance sheet here in just a minute. But when we take a look at volume, which is really important, you can see that with today's downward move, we did have slightly increased volume, but still below average. So you could argue that, yeah, we just moved down from a slightly overbought condition. We still closed on the 10-day moving average. There wasn't any real significant volume on the selling, and all that would be very valid. If you're bearish, you can say, well, we've got a nice pivot point right there where the wave 4 correction ended, exactly at the 61.8% Fib level, and here we are, we're starting a downside move. Couldn't really argue with that scenario either. So let's take a look at the VIX. You can see that we have consolidated down here at 20, and again, with the movement to the downside in the market, no real move in the VIX, so there was no panic in the market. This wasn't any sort of significant selling. We need to have a much bigger move off of this support level on the VIX, but we did move a little bit to the upside. There's still a possibility, though, that we break below that 20 level and come down and look for support in that 17 to 18 range, and that's what you'd need if you're looking for the market to turn and move back to the upside. It'd have to move up a bit here to disqualify this 5-wave impulse pattern to the downside. For now, it's intact. And Tuesday night in TradeFinder, we looked at the 10-year and said, well, with the way the 10-year is moving, a little bit of a triangle that we had there, a little bit of an ascending triangle. You can see right here that at least up till then, the Federal Reserve had not started withdrawing liquidity as they said they were going to. They have been raising rates, and they've been raising rates faster than they expected, and so it brings in that whole conspiracy theory of, are they just kind of manipulating things going into the election cycle with the midterm elections coming up? Or you could give the Fed a little bit more of a favorable viewpoint on it of saying that they're kind of trying to be status quo. They are raising rates faster than they expected to, so they've opted not to withdraw liquidity, not to reduce their balance sheet as they said they were going to try to counteract each other and just let things play out into the elections. That's given the Federal Reserve a little more credence than I normally do, but it's an argument that one can make. Nonetheless, we had a breakout to the upside in rates on the 10-year today. You can see that wave 4 is right at the 38.2% Fib corrective level. We've got a lot of congestion right through here on rates. So if rates are going to continue to the upside and they do break above that level, say they break above 31 there, then I think that's pretty meaningful, and we likely are off to trying to hit that wave 5 target as we move to the upside. I mentioned in the intro the dollar was up today as well, so there's the move higher in the dollar. That's a fairly vertical move. Remember, we've already hit way back here on the 14th of July the midpoint, right smack in the middle of that tap box, right where the wave 5 forecast is. The tap box is still there, so could we go higher? Interest rates moving to the upside today, the dollar moving to the upside today. I think that warrants taking a look at the Fed's balance sheet to see have they actually started withdrawing liquidity. This is their balance sheet up to the 17th of August, as you can see, so it doesn't count the last few days, but note there was a little bit of a rollover here. We had highlighted in the last update that the Federal Reserve did not really withdraw liquidity in the month of June. We're waiting for those official July numbers, but you can see by the curve here that things have started to the downside. Did they accelerate today? Is that why the 10-year was up? Is that why the dollar was up? Because we're starting to see that withdrawal of liquidity. I think that's a valid argument as well. We'll see into next week if that continues, and if rates continue to the upside, does the dollar continue to be strong? We'll see how that plays out. But I thought you might be interested in taking a look at where the Fed's balance sheet actually is, and I think that rollover there is warranted, especially moving into next week with the little bit of a down market that we had today. We also talked about Bed Bath & Beyond, the whole meme mania in Tuesday night's TradeFinder. And by the way, if you haven't signed up for TradeFinder yet, do so. You can do it right underneath this video, or you can go to our website at ewotrader.com. It's free. We do it every Tuesday night, 9 p.m. Eastern Time. We talk the markets, we look for trade considerations, and we have a live Q&A at the end. It's a lot of fun. Love to have you come along and join us. I talked to anyone I could talk to, and I know people that got absolutely wiped out today with that move to the downside after Brian Cohen announced that he had sold his entire stake. There was all this chatter. It just did remind you of the whole meme mania back in 2020 when we had COVID and everything else going on. To be so cautious. If you've ever heard any of my videos, you know I'm really concerned when things go vertically up because often they come vertically back down. And that's exactly what happened. But as I said, I personally know people that got crushed today with that move back to the downside. That's the danger of getting in that space. It's extremely risky, and I just urge caution to everyone viewing this. Be very, very careful getting involved in that scenario. I also talked about in the intro that Bitcoin broke out of its triangle, and you can see we talked about this Tuesday night as well, where we had this really tight ascending triangle, and I've mentioned numerous times, you saw the upward break on the TNX, the 10-year, out of its ascending triangle, but now we have a downward breakout in Bitcoin. And these triangles, if you've read that an ascending triangle means you're going to break to the upside, a descending triangle means you're going to break to the downside, data does not support that. I've done an awful lot of work. We have an entire portfolio at Elliott Wave Options specifically for trading breakouts of triangles using a very unique way that we structure our triangles for that. When you have a triangle, regardless whether it's ascending, symmetrical, or descending, you're going to get a breakout, but there is no rhyme or reason as to what the direction is. And what we talked about, and we also talked about this in last night's insiders meeting, which is for our alert subscribers only, and we do an extended Q&A there, that we're going to get about a 4,000 point move out of Bitcoin. And I said, kind of right on cue last night, I don't think it's going to take very long to find out, and boy, we didn't have to wait very long. So there was about a 4,000 point move forecast in this triangle, which meant a downside breakout likely brings us back to 20,000. Had we broken to the upside, we were going to run up and hit our head around 28,000. So sitting right there at 24, 4,000 point potential to the upside or the downside. You can see we went lower. I think the likelihood here is that we do go down to 20,000 on Bitcoin, but I'm curious as to your thoughts. Will it hold? Will 20,000 hold again? You can see how it held all through June and July. We have that wave 5 there, but it was only a bounce at the 61.8% extension. Again, my favorite fib extended level. Are we going to break down below that? What do you think? Leave a comment underneath the videos whether you think Bitcoin can hold 20,000 and this is just, a bit of a head fake to the downside before we turn and go back higher, or is something more nefarious afoot? Are we going to break below 20,000 and head lower on Bitcoin? I'd really like to know what your thoughts are there on Bitcoin or any of the cryptos, Ethereum, whatever you want to talk about as far as crypto land. But you can't avoid what happened today of that significant move lower. It bears paying attention to. So I thought we'd go ahead and take a look at gold as well. Almost to the 38.2% fib level, and we've rolled over, and look how we're just kind of coming right down that 45-degree angle, that targeted line. Remember, that's a projection. That doesn't mean that it's expected to move on that line. It's just a projection down to the wave 5 target, but it's pretty interesting that gold has been tiptoeing right down through that projection line. And you can see we tried, we didn't even make it all the way up to 170. We had a little bit of a bid there in gold from 160 up near 170, but it proved to be too much. We're heading back down, so we're probably coming down to test that 160 level. Will we break that wave 3? Well, if this impulse pattern holds, then you can see where the target is for GLD down there around 150. Let's go back and take a look at some of the markets. Looking at the Dow, the diamonds, the DIA, you can see that wave 4 is up a little bit above that 61.8% fib level, but not at a point where it would disqualify the pattern. Pretty impressive that we were able to get a little bit of distance above that support resistance area there at 330. So as long as we hold above that, again, if you're bullish the market, you can say, hey, we're above 330, we're above resistance. All we did was come down to the 10-day moving average. Same scenario that we had with the SPY. We bring volume into the mix here, and really less volume on the Dow than we had on the S&P today. So you get a low volume move lower, back down to the 10-day moving average. You can't be super bearish yet, especially with that VIX still hanging around 20. But I think caution was thrown to the wind today to be real careful here. We still have this gap down at 330, but it wouldn't be surprising to see us come down and test 330, even if the market was going to turn and move back to the upside. I still feel like the Fed holds the cards. But something that we haven't looked at recently, we've talked about this in both the events this week. Have you seen the yield curve? Take a look at the yield curve. Talk about an inverted yield curve. Normally the yield curve inverts slightly. This is huge. There's the 2-year right there, and then the 10-year is way down here. There's a significant yield curve inversion between the two 10s, which is what most people look at as far as forecasting a recession. As you know, we've talked about it. It's been all over the financial networks. A mild recession is what's priced into the markets. But boy, when we just have a continuing yield curve inversion like this and it's that significant, it's kind of hard to say that it's only going to be a mild recession. Even with interest rates moving back to the upside today, we're still inverted. Pretty impressive. That's a really significant inversion there, so I thought you'd be interested in taking a look at that. Taking a look at the chart of the Qs, as you know, we had a wave 5 to the downside here. So when you have that and it's greater than 100%, you are not looking for a retracement all the way back to the previous 4. What you're looking for is a retracement to the 61.8% fib level. Exactly where we went on the Qs. So wave 5 extended past 100%. You look for a 61.8% corrective move right at, a doji at the 61.8% fib level. If you're new to watching us here on our Elliott Wave options channel here on YouTube, and you're new to Elliott Wave, Elliott Wave Fibonacci, it's just been spot on. So hopefully that's something that will interest you and putting that into your arsenal for your own technical trading. Now, we did break below the 10-day moving average on the Qs, which I think is interesting. Remember, we've been talking about going back months and months. I felt like the Qs were going to underperform no matter what happened in the markets, where we end up at the end of the year. With interest rates going to the upside, it's usually hard on tech stocks. We felt like the Qs would underperform the markets, and the Qs have broken below the 10-day moving average, where the SPY and the diamonds are still sitting on top of the 10-day moving average. So we've done what we're supposed to do on this pattern. The wave 5 ends, you retrace 61.8%, so you may be wondering, what do you do now? Well, at this point in time, this is where you exercise patience with Elliott Wave and you let the next impulse take shape. You don't want to guess because that's all you would be doing at this point in time. It's done exactly to a T what's supposed to happen with an Elliott wave pattern, and once that's complete, you let the new impulse wave start, and then you jump in. So you exercise patience and wait for that to occur. Looking at the IWM, look at that, a perfect 50% corrective level, a doji there as well. Heading back down, we look at the moving averages, the IWM also breaking below the 10-day moving average. So if you're kind of a believer that small caps and tech stocks are market leaders, then you'd be a little concerned that those two markets have broken below the 10-day moving average there. And we've talked about these trading range levels in ad nauseum here. As you know, we had beginning of the year, we were moving between 190 and 210. That was the range. Then we broke down below 190, and so we oscillated between 170 and 190. We did get above 190, but is it going to hold? We'll have to wait and see how that plays out. You look at volume here, a little more volume, kind of reminiscent of the SPY, increased volume, but still below average. So you look at it, but it's hard to put a lot of weight into things until volume really picks up. We are going to be moving into September soon. May and September are historically the two worst performing months in the market. With May, you understand, everybody's funding their IRAs and 401ks in April. Lots of money comes into the market, and then you just kind of have a vacuum in May. So market tends to underperform in May. Then you have the summer doldrums. There's an old expression, never short a dull market, meaning that the markets tend to drift up on lower volume in the summertime. Everybody comes back, kids are back in school, all the traders are back, the summer's over, volume picks up, and oftentimes you'll get a retracement to the downside of that drift higher that occurs during the summer. Is that all that's going on? Again, another argument that you could make as far as what's occurring in the markets. Let's take a look at Australia. Australia, 45% wave force, so above the 38.2, but it didn't quite make it to 50%. But we had a lot of support resistance right there at 23, which is where we ran up to. Now we've broken back below that level. If you're long the Aussie, you wanted to see that 23 level hold. It didn't. Looking at the moving averages, you can say, okay, well, we broke the 10-day, but we're sitting on top of the 50-day moving average with the three moving averages all pretty close together there. So there's probably a little bit of support with where we are right now, but it's hard to imagine that we don't come back down and at least test 22. If we break that, then you're all the way back down here at 21 and threatening to go test that wave 3 low that occurred back on the 14th of July. Looking at Canada, another market that had a wave 5 that corrected past 100%. So you know the deal. You have a wave 5 that extends more than 100%. You only look for a 61.8% corrective move. There it is again. Right back to the 61.8% level. We stayed there for a week, breaking down today. You look at the 10-day moving average, broke below the 10-day moving average on the EWC as well. But the 50-day moving average is sitting there at that 50% corrective level. So you would think we're probably coming down there, and there is some support there. You see, if we draw the line here, right exactly where the 50% corrective move is, there's support resistance there as well. So you're going to see if Canada can hold that level there right around 35. Looking at India, we've been commenting on how impressive the market had been in India with this move up and not a significant, at least yet, retracement of that vertical move. I told you how I don't like vertical moves, and it continued up, but now a gap down there. So are we coming back down with India? We got dangerously close to disqualifying this 5-wave impulse pattern, but it's got to break that 78% fib level to officially disqualify a 5-wave impulse pattern. We got in the area, but we didn't quite make it there. We came up and got some resistance there at 44, which is a pretty strong support resistance area, gapping below the 10-day moving average here on the INDA with the separation there. We're likely coming down to test that 50-day moving average at least here. But again, these corrective levels could just be that if we are going to turn and move back to the upside. But I go back to if the Federal Reserve is going to start withdrawing liquidity, it's going to be very difficult for the markets to move higher in a scenario where you have the Federal Reserve raising rates more aggressively than they expected to and a withdrawal of liquidity. In the last recording, we talked about the double whammy. That's what the double whammy is. Some of you are asking, what's the double whammy? That's what it is. And then Germany, here we go again. Right back down, right up to resistance there where that wave 4 set up, right at that resistance level at 24. We couldn't break it, so we're moving back to the downside here. You look at the moving averages, we're below all of them in Germany, in the EWG, 10, 30, and 50. We're below all those levels. Perhaps we find a little bit of support here at 23. I don't know that that's a very strong level. It looks like we're probably coming down to 22 and maybe even testing the wave 3 low there. And you can see where the wave 5 is, all the way down at 19. So it looks like Germany has rolled over, just moved back up to resistance, and then heading back down again. And Germany is just, Elliott wave has just been nailing the EWG for the last year and a half or so. Thought I would throw Tesla into the mix here because you can see Tesla, a lot of people have been asking about that lately, and the reason I wanted to show you this chart is we have a pretty nice little triangle formed here. It's not the greatest formation that I've seen, but it's a decent symmetrical triangle with the lower highs and higher lows. And you can see we tried to break out of it today, didn't really do so, with the midpoint there right around 920 and forecasting about 100 points or so on Tesla to break to the upside or the downside. When you have a triangle, as I said, you have to respect a potential break in either direction. So we come down here and set the wave 4. Do we continue higher up towards where that wave 5 is, around 1,000 or so? Both those levels, if we break out of this triangle, the expected move would get you somewhere around those two levels. We'll see if that wave 3 can continue up towards this potential target or if we're going to break lower. But something's getting ready to happen with Tesla out of this triangle. You saw what it did last time. So we had this triangle pattern here, and you could argue whether that's an ascending triangle. You could even make a bit of an symmetrical triangle out of it, but I think it looks more well formed as an ascending triangle. You have the upside breakout. You know the rules now, at least if you've been watching these videos. When you have an Elliott wave corrective triangle, the breakout is retraced an extremely high percentage of the time. It doesn't always happen immediately. It's just like filling a gap. Sometimes it does it immediately. Sometimes it takes some time. But if we do break to the downside, are we going to stop at this wave 4, or are we going to come all the way down right to where the point of the breakout is? So that brings you all the way down to around 760 or so on Tesla if we do indeed get a downside breakout out of that triangle next week. But it's something to look at for going into next week. What direction does Tesla break? In the last recording, you all asked about, hey, what about the UK? So let's add that one into the mix before we wrap things up in this update. And you can see that same thing here. We had a wave 5 that corrected more than 100%. So we're looking for that 61.8% corrective level. And once again, bam, dead on the 61.8% correction with a bit of a doji here in the UK market as well. So all of these, Elliott wave, Fibonacci, hitting every one of these markets spot on, and then we're turning and heading back down. You can see a little bit of a gap lower, also breaking below the 10, 30, and 50-day moving averages, which had converged to a very similar point there, right around where this 50% corrective level was, and I mean correction back to the upside here following the completion of the wave 5. Remember, in Elliott wave, a corrective move is a move against the previous impulse. Correction is often identified as a downward move, not an Elliott wave. Correction is a move against the previous impulse. So we had a move here, right back to the 61.8. Again, did exactly what it's supposed to do. So same scenario, it's done exactly what it's supposed to do. Let the next impulse set up. You don't have to always have a trade on. Sometimes the best trade is no trade. Wait till the percentages are more in your favor, and then that's when you step in and trade directionally. That's how you become successful over the long term. Hope you found this informative. Thanks for your time. Have a wonderful weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.